Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's videos, and all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the four things we learned in the markets this week, starting with point number one. Point number one is it was not a great week for stocks, and it can most likely be directed towards the same story we've discussed for nearly 2 years now: interest rates and inflation. While there was no inflation data per se released this week, the Federal Reserve did have one of their regularly scheduled meetings, and I almost said monthly there, but these meetings are in fact not monthly. As a matter of fact, the next meeting is in 40 days from today, Friday, September 22nd. They'll meet again in 40 days from today. Fed President Jerome Powell said nothing we don't already know about the economy and specifically the labor market, which is hot, which is providing it difficult, or at least in their mind, it makes it difficult to push the inflation rates from 3, where we're currently at, down to that 2 level where they want to be. And thus, they may need to keep rates at these higher levels for longer. Higher, longer. That's the theme of what we've been hearing lately. At this point, the November 1st meeting we discussed above, there's a 73.7% probability that rates do not rise but stay at their current levels, according to the CME Group, seeing on your screen here. But the December meeting is a different story entirely. While the odds on favorite is still to stay at current levels, 54.8%, there's roughly a third chance that we raise 0.25% and about a 7% chance that we raise 0.5%. All that had the markets not feeling so great, and thus we got what we got this week: not very good stock market results. In some more positive news regarding stocks, Seagen, whom Pfizer is in an agreement to purchase, they saw their shares rise 3.5% after they had positive results from a phase 3 study of a cancer drug combination included with their Padcev treatment. Now, I may have pronounced that wrong, but suffice to say, some good news from cancer treatment perspective there. And if you're a gamer, if you like to play video games, we saw Activision Blizzard this week, their stock rise after Microsoft was able to clear one of the last major hurdles to acquire the company in the UK. Each week, we also track the initial claims for unemployment insurance to see if that number is starting to lift, which presumably would be a precursor to any future issues in the labor market. And this week, they actually dropped. They went down, which is incredible. That is incredible. They dropped to 201,000 initial claims for unemployment insurance. So as Chair Powell continues to stress, labor market strength is weighing on inflation, weighing on keeping it higher. Only 10 of the last 90 readings have been lower than this week's reading. And we've been in a good labor market, so that shows how impressive this week's number is. Each week, we also look at the Atlanta Fed's GDP Now model to get a real-time estimate of where the U.S. economy is currently at. And this week, after receiving data around real residential investment growth and inventories by businesses from the U.S. Census Bureau and the Bureau of Labor Statistics, we saw GDP for the quarter, at least the estimate of it, stay consistent, 4.9%, unchanged from the previous week. That's actually a win in and of itself, because if we can keep this 4.9, it's going to be an incredible quarter. With only 1 week left to go in the quarter, this is the period of time where these numbers don't change too much. All the data that goes into them, into the growth of our economy, has pretty much been released. So now it's just time to see how accurate the Atlanta Fed actually is. And their record is typically pretty darn good when you get this close to the end of the quarter. But obviously with such a big number, 4.9%, many are going to be watching the GDP number when it gets released next month to see how accurate the Atlanta Fed was with their very optimistic estimates. And finally, let's see how the markets fared this week. The S&P 500, which is our proxy for growth and growth in income, but only when taken together, combined, that was negative 2.93% for the week, making it 3 straight negative weeks for that index. The Russell 2000, which tracks smaller and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was negative 3.78%. And the MSCI EFA, which tracks our international stocks, that was negative 2.07% for the week, taking the prize again as the lowest loser. Point number 2, as discussed above, the Fed met this week. And a few takeaways from those meeting minutes that we got released and the press conference that happened after the meetings. Well, first, the FOMC made it clear that they are close to what they think is the right level of interest rates to achieve to get to its 2% inflation target. How long will they have to keep them there? That's still the question. That's what's totally undecided, but they think they're at the right level from an interest rate perspective. But at a minimum, they've hit the right target of where they want to be, or somewhere in the range. Now what you're starting to see is more market-based rates start to climb, because now remember, the Fed does not set the market-based rates. They don't set the 2-year Treasury, the 10-year Treasury. They set the Fed funds rate. So you're starting to see market-based rates climb to account for the fact that in 2 years, it's quite likely that market-based rates will be close to the Fed funds rates if they're going to keep them higher for longer, which could mean 2 years. Now take a look at this chart of the 2-year and 10-year Treasury bond rates alongside of the effective Fed funds rate. While not identical, there is correlation there. As you can see, with more upside potential in the markets, in the Fed funds rate, as we looked at earlier with the CME group, there is still a decent chance of more rate increases, albeit not large, probably 0.5%, 0.25%. This is why we've recommended to our advisors, take duration out of the picture. Buy short-term treasuries paying 5.5% for the safer side of your client's portfolio. Buy or be in a fund that has a shorter duration. I'm happy to talk to you more specifically about your portfolio and what we've done in regards to fixed income. If you'd like to talk about that, to how we've tried to hedge rate increases this year, we've definitely seen. If you bought a neutral duration bond fund like the AGG, the iShares Total Bond Fund, or the BND, the Vanguard Total Bond Fund, you're pretty much flat for the year because of exactly this, that the market is now saying these market-based rates are coming up to meet the Fed funds rate because we think we're going to be there for longer, higher for longer. So back to our meeting. The FOMC's dot plot committee, which gives their view of where they think rates will end the year, has 7 members thinking no further rate increases are needed, but 12 members believe another 0.25% hike is needed. We also heard Chair Powell articulate that he feels the risks that they need to be cognizant of are now two-sided. Inflation on the one side, which we've known about, and if they get too aggressive with interest rates and thrust the economy too far off the rails, then we might be looking at a deep recession. So he needs to worry about that now as well too. He was also had an honest assessment that said it's not a baseline scenario that they land the economy in a soft format, as many are hoping for, a soft landing, based on the amount of lag time between monetary policy that they control and the economic outcomes that those decisions directly result. He would by no means rule out a recession happening. That again is why we continually monitor that GDP Now model to try and see how real-time data is affecting the growth of our economy. Overall, nothing earth-shattering at this meeting or any of the statements, and we'll get to see 2 more meetings before the year's over, and we'll try to summarize those for you as best as we can in this video series as well. Point number 3, the other thing we saw from the Fed's meeting was their summary of economic predictions. Thank you to my friends at DataTrek for putting this nice chart together. This nice chart compares the most recent projections to those that were released in June of this year. And there's some changes. The newest variation of this just released is what you're looking at. And it has now 2026 numbers included as well. So there's no June comparison to them, the 2026 numbers, because they weren't in there in June. So those are new. We get to look at those for the first time now, what they think is going to be happening in 2026. A few things I'll point out. Look at the expectations for the Fed funds rates for both 2023 and 2024. They're now expected to be over 5% on the Fed funds rate. One question I get from clients when purchasing a 3-month or a 6-month treasury is, what does my reinvestment risk look like? What will rates be when I need to buy another treasury bond when this one comes due in 3 or 6 months? Should I not need the money and again want to put it back into a treasury bond? Well, one doesn't know for sure, but it doesn't look like the Fed funds side of the equation is showing that short-term rates will be dropping in 2023 and 2020 and or 2024. Also notice the estimate for GDP from June to now for 2023. Perhaps because of the strong economic data we've been seeing built into the Atlanta Fed's GDP Now model, they've been forced to raise their full year forecast on GDP growth to over 2, and they've increased the 2024 numbers as well. And finally, point number 4, more bad news on the real estate front. U.S. home sales fell to their lowest level since January of this year, dropping to a seasonally adjusted rate of around 4 million existing homes sold. Compare that to September of 2020, when we were seeing about 6.4 million homes being sold at that time. And the number should hopefully keep going up with population growth and new homes being built, but it didn't. Existing homes, as you can imagine, they make up most of the housing market. And this number in September is about 15.3% less than just even a year earlier. This is obviously partly to blame because of the fact that the 30-year average mortgage rate, which you can now see on your screen, hit 7.19% last week, and it has been steadily over 7 for a lot of this year. All this lack of supply has pushed the national median price of a home from $365,400 earlier in the year to nearly $412,300. Now, why is that bad? Why is that bad? Well, here's my fear with all this. You buy a house today with a 3% down payment because you can't afford the 10 to 20% you need on today's home price. Prices are so much higher, inventory is so much lower. You get stuck in PMI insurance. Gross, that's disgusting. And then you buy homes at their peak. We see values come down when supply normalizes, and supply will normalize at some point in time, which in theory, with more supply and similar demand, should lower prices. Then you can't refinance because the 3% equity you had, because you could only afford a 3% down payment, got zapped away with a 10% price correction. And you're stuck in a 7% mortgage while everybody else is refinancing back to the 5% their realtor promised them was coming, which is why it's okay to buy now, probably pushing them into a home much sooner than they should have actually been in there. This is why you have to follow Dave's principles on buying a home, especially in today's real estate market. If you're going to buy today, and if you're ready, I wouldn't tell you not buy. I wouldn't let this market stop you. If I was ready, go ahead, buy. But that being ready means you got the 10 to 20% down. So when rates drop, you can take advantage of them. And you don't have to pay these grossly expensive and only benefiting the banks PMI insurance. Okay? Supply will normalize at some point in time. When that does, again, unless demand meets it, prices should fall. It's basic economics, okay? Now, if for some reason demand goes through the roof as well too as supply increases, then you could see prices stabilize a little bit. Not calling for any sort of major real estate crash. Don't hear that at all. But again, look at the values you've seen increase this year. If that normalizes, that's approximately, roughly 10-ish% or somewhere in that range. And so all that to say, this is why we love the principles taught by Ramsey and Ramsey Solutions. You know why? Because they keep you out of the danger zone. They're your guardrails. Everybody likes to bang on Dave about this or that. You know what Dave does? He puts wonderful guardrails in your life so that you don't get yourself in a situation where your ability to live and give like no one else is compromised. Okay? And especially then as a Christian, 7 out of 10 Americans are living paycheck to paycheck. Is it different in the church? In the Reformed church? In the evangelical church? Is it different? Nope, unfortunately not. 7 out of 10 Americans in the church are living paycheck to paycheck. How can I glorify God with my first fruits when my first fruits have to go to JP Morgan Chase or Discover? Can't. Which is why Dave's principles are not here to make you rich so you can love money and glorify money at the expense of God. No, these principles are here so you can glorify God, and money doesn't have to become a problem that gets in the way of you glorifying God. By giving God his first fruits, by giving God an offering, by being so stressed I can't share the gospel with my friends, all those sort of things. That's why we love what we do, because we help you live out your gospel mission, just the financial part of your gospel mission. And eventually one day that part of that should be, okay, I'm going to help make this money when I don't need it anymore, or as I pass on, take the gospel to the ends of the earth. Sure, I want to give something to my kids. They need everything? Nope. You know what they need? They need your ideas. They need your advice. They need your wisdom. They need your guidance. They don't need your money. They don't need your money. So all that to say, we hope that this 4 things we learned in the market this week was very helpful to you. If it was, would you do us a favor? You can do us a favor by hitting the like button. The like button helps us with Google and YouTube's algorithms, because their algorithms work like this. You watch the video, you don't hit like, then they say, that wasn't very an impactful video. Thus, we're not going to show it to Billy or Susie or Johnny when they come onto YouTube and search for financial advice. As well as you can hit the subscribe button. The subscribe button just makes sure you get the video as soon as it's released with a nice notification from YouTube or Google. As well as if you'd like to schedule a meeting with any of our financial coaches who help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live debt free, hold you accountable to those goals. Or maybe you've got a kid in college and you just need some help on saving on the cost of college. Our financial coaches are trained in doing that. You can schedule a meeting with any of them right at that link, or you can schedule a meeting with our financial planners who help you in baby steps 4, 5, and 6, help you start baby step 4, where you can start hitting that Roth IRA, making sure you're doing your 401k to the appropriate amount. And then if you've got a kid in college, helping you save for college. Coaches help you save on the cost. Our advisors help you save for college. And you can help get a plan to pay off your mortgage so you can live and give. That's the most important part, like no one else. Thanks so much. We'll look forward to seeing you next week.